Long-term investing is not just about picking the right stocks or assets. It's a comprehensive strategy that requires a combination of financial acumen, psychological fortitude, and the ability to adapt to changing market conditions. Over the years, renowned investors have shared key insights that can guide individuals seeking success in long-term investing. Below are additional insights from different angles, illustrating how investors can enhance their strategy and increase the chances of achieving long-term financial goals. Understanding the importance of behavioral biases. One of the most overlooked aspects of investing is human psychology. Investors often fall victim to cognitive biases such as overconfidence, loss aversion, and herding behavior. These biases can cloud judgment, leading to rash decisions during periods of market volatility. Behavioral finance experts, such as Daniel Kahneman and Richard Thaler, emphasize that recognizing and mitigating these biases is essential for long-term success. Kahneman's concept of prospect theory, for instance, explains that people tend to fear losses more than they value gains, which can cause them to sell in panic during market downturns, missing out on future gains. Successful long-term investors understand the power of emotion and deliberately work to stay rational, focusing on the fundamentals of the investment rather than short-term fluctuations. The importance of rebalancing portfolios. While diversification is critical to managing risk, maintaining an effective asset allocation over time requires periodic rebalancing. Over time, asset values change, and a portfolio that was once diversified might become overly concentrated in one sector or asset class. As markets grow and shrink, it's essential to regularly review and adjust the portfolio to stay aligned with long-term goals. Vanguard founder Jack Bogle often emphasized the importance of rebalancing for passive investors, ensuring that an overexposure to a particular asset class doesn't jeopardize the portfolio's risk-return profile. Though rebalancing is a simple concept, it's an important one to keep portfolios on track and to avoid a set-it-and-forget-it mentality that can lead to higher risks. Embracing a long-term mindset and ignoring market noise. One of the greatest challenges for long-term investors is resisting the temptation to react to market noise. News headlines, market volatility, and investor sentiment can easily sway decision-making, but these short-term fluctuations often bear little relation to the long-term performance of an investment. Warren Buffett, one of the most famous long-term investors, has frequently advised investors to ignore the noise and focus on the intrinsic value of the businesses in which they invest. Similarly, Peter Lynch, former manager of the Magellan Fund, advised investors to buy what you know, meaning that individuals should focus on businesses and industries they understand and can analyze over the long term. By ignoring the daily market fluctuations and focusing on fundamentals, investors are more likely to remain steady through market cycles. The role of dividends in long-term investing. Many investors focus primarily on capital appreciation and overlook the power of dividends. However, dividends play a significant role in building wealth over the long term. A study by the National Bureau of Economic Research found that dividends account for approximately 40% of the total return in U.S. stocks over a period of 70 years. Investors who reinvest dividends enjoy compounding benefits, which can significantly accelerate the growth of their portfolio over time. Dividend growth investing, focusing on companies with a strong track record of increasing their dividends, can also provide a steady income stream, which is particularly attractive during periods of market volatility. Investors like John Bogle, who championed low-cost passive investing, often recommend dividend-focused strategies for building wealth over the long term. The power of patience and avoiding short-term trading. The temptation to engage in short-term trading can derail long-term investing success. Many investors are seduced by the idea of making quick profits by timing the market, but this strategy has proven to be difficult and costly over time. A report by the Dalbar Group has consistently shown that investors who try to time the market underperform those who adopt a passive buy-and-hold strategy. Studies reveal that missing just a few of the market's best days can significantly reduce long-term returns. Legendary investors like Warren Buffett, Charlie Munger, and Jack Bogle have long argued that successful investing is about staying in the market for the long haul, allowing investments to grow over time. By resisting the urge to make impulsive decisions, long-term investors can avoid selling during downturns and can benefit from the compounding growth of their investments. Staying informed, while avoiding overanalysis. While staying informed about market trends and economic conditions is crucial, it's important to strike a balance between gathering information and overanalyzing. Paradoxically, excessive information can lead to decision fatigue, causing investors to second-guess themselves or fall victim to analysis paralysis. Charlie Munger, the vice chairman of Berkshire Hathaway, often speaks about the importance of mental models, which involve understanding core principles in economics, psychology, and investing, rather than becoming bogged down in the details of every short-term development. Munger and Buffett advocate for investing in businesses that are understandable and focus on investing in companies with strong, simple business models that will thrive over time. This approach enables investors to avoid being overwhelmed by the noise and the complexity of constantly changing markets. Learning from failures and adapting to changing conditions. The ability to learn from mistakes is an invaluable trait for long-term investors. No investor, no matter how skilled, is immune to making errors. In fact, even the most successful investors acknowledge that failure is an integral part of the journey. Warren Buffett has often pointed out that his success is partly due to learning from mistakes and making adjustments to his strategies. When mistakes occur, it's important not to get discouraged, but to view them as learning opportunities. Additionally, investors must remain flexible enough to adapt to changing market conditions. A strategy that works well in one market environment may need to be adjusted in another. By staying open to new information, continually learning, and adjusting strategies as necessary, long-term investors can stay on course even when market dynamics shift. Understanding the cost of active management. One of the key lessons for long-term investors is understanding the costs associated with active management. While actively managed funds might promise superior returns, they often come with higher fees, which can significantly eat into long-term profits. Over time, the cumulative effect of fees can reduce total returns, making passive investment strategies, such as low-cost index funds, a more attractive option for many investors. Jack Bogle was a pioneer in promoting index fund investing, which allows individuals to participate in the overall market without the need for expensive fund managers or active stock picking. By focusing on minimizing costs,